The Monetary Policy Committee, MPC, met on March 21, 2022, in an environment of heightened geopolitical tensions and persisting macroeconomic uncertainties, associated with the recent Russia-Ukraine crisis and headwinds stemming from the lingering impact of the COVID-19 pandemic. The committee reviewed developments in the global and domestic environments in the first quarter of 2022 and the outlook for the rest of the year. This video shows the highlight of the MPC decisions and impact of these decisions on the Nigerian capital market. According to the MPC's communiqué, the committee decided to retain all the policy rates, to indicate a conservative but cautious and consistent policy choice, given the prevailing conditions and outlook of the economy. It also feels that a hold stance would signal Monetary Policy Committee's realization of the fragility of the growth recovery, and its sensitivity to emerging global and domestic uncertainties. To this end, the committee unanimously voted to retain the monetary policy rate, MPR, at 11.5%, the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, the cash reserve ratio at 27.5% and the liquidity ratio at 30%. The table shows the snapshot of equity secondary market before and after the MPC meeting. From the data, it appears equity market shows a strong resilience after the initial shock of capital flight following Federal Reserve's rate hike previous week. Sustaining this upward momentum would largely be dependent on the level of domestic investors' participation in the market. The table shows the snapshot of FGN bond secondary market before and after the MPC meeting. Generally, FGN bond yields inched up across all the maturity spectrum after the MPC meeting despite MPR being retained at 11.5%. Factors responsible for the upswing in yield may include profit-taking by investors, search for positive real rate of return resulting in bonds sell-off, and capital flight by FPIs. Market expectations depend largely on inflation rate direction, hence, we have two scenario perspectives to consider. Scenario 1: if inflation rates slow down, then the likelihood of the following occurring is very high. 1. Borrowing cost would reduce leading to market liquidity. 2. Demand for goods and commodities would increase owing to access to liquidity. 3. Traditional assets would witness more investment owing to market liquidity and better ROIs. 4. Naira may strengthen marginally as portion of potential liquidity for speculative FX trade have been channeled into traditional asset classes. 5. Low interest rate volatility. Scenario 2: if inflation rate increase, then the likelihood of the following occurring is very high. 1. Borrowing cost would increase leading to liquidity squeeze in the market. 2. Demand for goods and commodities would nosedive owing to market illiquidity. 3. Investors' appetite for alternative assets would increase in order to outperform inflation. 4. Naira may weaken the more as investors' appetite for dollar-denominated assets increase. 5. MPR hike very likely to curtail inflation rate impact.